Most people think silver shortages start with a sudden price spike. They don't. They start quietly. When supply tightens, deliveries slow and the price stays calm. And that is exactly what we are seeing right now. If you only look at the silver price, nothing looks wrong. The chart looks stable. There is no panic, no urgency, no mainstream coverage. That calm is exactly what makes this moment dangerous for unprepared investors. Here on the silent ledger, we focus on what happens before the headline phase. Because silver never breaks in public first. It breaks quietly inside the physical market. Silver is not a large, flexible market. It is a tight industrial metal with limited physical supply. Most silver is mined as a byproduct of copper, lead, and zinc mining. That means silver production does not respond quickly to higher prices or rising demand. Even if demand doubles, supply barely moves. That imbalance is why silver reacts so sharply when pressure finally escapes control. When physical stress begins, the market does not announce it. Instead, it manages it quietly. Delivery times stretch. Availability becomes selective. Communication becomes vague or delayed. These are not random signals. They are classic early warnings. In past silver cycles, this exact phase appeared before major moves. Price stayed calm while supply conditions worsened. Most investors ignored it until the reaction came suddenly. One of the biggest mistakes retail investors make is believing price leads the market. In silver, price almost always follows physical reality. Paper markets can create the illusion of stability. They can absorb pressure for a time, but they cannot create physical metal. That's why physical supply always wins in the end. Right now, we are in what experienced market watchers call the compression phase. Pressure is building, but it has not yet been released. These phases do not last forever. When compression breaks, price does not move slowly. It jumps. That is why smart money does not wait for confirmation. They do not wait for headlines or social media panic. They position during periods of boredom and disbelief. This is also why silver moves catch people off guard. The public sees nothing wrong until suddenly everything changes. At the silent ledger, our role is not to predict exact dates or prices. Our role is to track conditions, and those conditions are tightening. Industrial demand continues to grow. Silver is critical for electronics, solar panels, energy infrastructure, and advanced technology. Unlike investment demand, industrial demand does not disappear during volatility. At the same time, above-ground silver inventories are not large. There is no massive buffer waiting to be released. When supply tightens, the system has very little room to absorb stress. This is why silver reactions tend to be violent, not because of speculation, but because of structure. Another sign many people miss is behavior. When institutions stop discussing supply openly, it is rarely accidental. Silence is often a strategy. If everything were fine, transparency would be easy. When pressure builds, communication disappears. We are seeing that shift now. This does not mean silver will explode tomorrow. It means the setup is forming. And once setup's complete, reactions are fast. History shows that silver does not offer long warning windows. By the time price moves, positioning becomes difficult. Liquidity disappears, and emotion takes over. That is why this quiet phase matters more than loud predictions. Here on the silent ledger, we track these early signals so viewers can understand what is happening before price reacts, not after. If you only follow charts, you are late. If you only follow headlines, you are even later. Watch supply. Watch deliveries. Watch behavior. Because silver does not break loudly. It breaks quietly first. If you value calm, informed analysis without hype, make sure you're subscribed to the silent ledger. This channel exists for investors who want to understand the market, not chase it.